Hello and welcome back to Coffee and Kale. My name is Nicole and today we are joined by Chris Mullings. He is a commercial lender in the lending space in primarily DC, Maryland, and Virginia.
Yes.
Okay, and we're going to talk about financing and becoming bankable as a small to medium-sized business. So that sounds interesting. Keep watching. Thank you for joining me this morning.
Thank you for inviting me.
I am so happy to have you here.
Well, this is my first time on camera, so
Is it?
there's a little bit of nerves, but
first time on camera and with Kale, so he is our first guest to have the Kale part of Coffee and Kale. What do you think?
I think it's excellent.
Yeah.
The fact that it's healthy. The taste might be a little bit unusual, but I like it.
That ginger's a little hard to
That's
stomach.
what it is.
Ginger.
That's the
it's
piece
a little bit hard.
I'm a big fan of ginger.
Yeah?
Yeah.
Okay.
I try and use it whenever I'm cooking, and if I'm
Okay,
gonna do
so that'll
something.
calm the nerves for first time on camera.
It does seem to be working so far.
Okay, so commercial lender.
Okay.
You are the first that we have had in the commercial lending space. All of our guests so far have been in some way, shape, or form attached to the residential part of the market, either lending or agents or home inspectors. So you are the audience's first foray into commercial lending.
All right. So,
Tell me more. You have been in this space for, I know you've been at the current company for about 5 years, but how long have you been in commercial lending?
So I've been in commercial lending since 1998.
Okay. I won't do the math. So just leave it there. Okay.
That's 25 years for anyone who wants to do the math. And I started at first as a credit analyst with First Union Bank.
Okay.
And that was in their Mid-Atlantic commercial real estate lending group.
Okay.
Now, when most people think of banking, right, they think of the direct associations that they have with it, meaning you go into a branch, you open an account, or they think of banking in the context of getting a mortgage. Right? The other element of commercial lending is what I do, which is making loans to small to medium-sized businesses, whether it be for working capital needs, whether it be to finance real estate acquisition, whether it be, and that real estate acquisition can either be buy and hold, meaning they purchase a property that they're going to renovate and then rent it, or they're going to purchase a property, renovate it, and then resell it, or house flipping as some people call it.
Got it.
Now,
Okay.
So at Capital Bank, the commercial real estate group is a separate entity.
Okay.
All right. So the residential renovation for resale business, that is handled specifically by the CRE group.
Okay.
I work in what's called the commercial and industrial lending group.
Okay.
So primarily, we make loans to small, medium-sized businesses, and for us, that means revenue size is $1.5 million annually or more.
Okay.
And while we will finance real estate, we tend to finance owner-occupied real estate on the C&I side.
Okay.
And what?
For business ownership?
Yes.
Okay.
So I'll give you an example.
I didn't mean to interrupt you.
No, that's fine. So I'll give you an example. Let's say that you wanted to purchase the piece of real estate that we are in right now.
Okay.
And you have an operating business of any kind that is going to occupy 51% or more of this space.
Okay.
We could provide you with a loan, and we would call that an owner-occupied commercial real estate loan.
And it's business owner occupied.
That's correct.
I see.
Doesn't mean that you couldn't rent out some portion of this space, but 51% or more of the space needs to be occupied by your business.
Okay.
And or 51% of the revenue generated by the property needs to come from the operations of your business.
Of the business. Okay.
Right. So in addition to that, we'll provide working capital lines of credit. So, businesses that have accounts receivable on their balance sheet, for example, they can finance those with a line of credit.
Okay.
And any other type of business expansion, business acquisition, those are the kinds of things that get financed on the commercial and industrial lending side.
Okay. So I often, as a residential mortgage loan officer, if this is your first time here, I am a home loan officer primarily for, not primarily, only for residences. But what I get asked a lot is, can I take a mortgage out in the name of my business? And it sounds like the answer is yes, so what kinds of qualifications would a business need to have in order to take a loan out for, let's say, this building here in the name of XYZ LLC? What do you look for?
So the primary qualification is the cash flow of the business.
Okay.
Right? So whenever banks are underwriting any kind of commercial loan or any kind of business loan, they look to 3 sources of repayment.
Okay.
The first source of repayment would be the cash flow generated by the business itself.
Okay.
So we'll take the cash flow, the revenue of the business, subtract all of the expenses, any other debt payments that they might have.
Okay.
And we want there to be a net cash flow number that provides sufficient coverage for the principal and interest payments that are going to be associated with that loan.
Okay.
Right? So
Okay. That's not
cash flow is number one. Number two would be the personal financial capacity of the business owners.
Okay. So
Now,
like a guarantor type situation?
Yes.
Okay.
Exactly. Now, and as a small to medium sized business, you are essentially joined at the hip with your business from the standpoint of the financial evaluation that a bank or any other financial institution is going to make.
Okay.
Right? And that's what separates large businesses. So like Microsoft, for example.
Right.
You know,
it's not guaranteed.
yeah, exactly.
It.
But that's a publicly traded company.
Okay.
Their financials are public. They have a long history and track record of positive cash flow, etc. So that's a completely different issue. When you are a small business, though, you are essentially your business. Your brand. Oftentimes, a business owner has multiple hats.
Yeah.
So he's handling inventory,
Right.
he's handling
Marketing,
HR function, marketing, etc., etc. So really, your particular efforts are going to make or break that
They're
business.
highly correlated with the business. Got it.
Correlated
Okay.
with business. So
Okay.
the second is, what is your personal financial capacity?
Okay.
What's your credit score?
Okay.
What is your debt to income ratio?
Okay.
How many debts do you have, either directly or indirectly? And I say indirectly because when you guarantee a loan for a business, it does not appear on your personal credit report. Right? So you could conceivably guarantee tens of millions of dollars of business loans without that actually appearing on your credit report. So you'd have to tell us, and then we kind of evaluate that. But so personal financial capacity is number two.
Okay.
And then number three is liquidation of collateral. So if we're making you a loan for you to buy a piece of owner-occupied real estate, we're going to evaluate if option number one for payment, which is the cash flow from the business, goes away, and option number two for payment, which is your personal financial capacity, is gone. Then we have to sell this property for the bank to get their money back. What are we going to be able to do that?
Okay. And is that, now I often get the question on appraisals, and it actually gums up residential appraisals, like if you include furniture in it or artwork in the contract for sale. But would you guys consider that in bucket three? Like, is it machinery that's in the business? Or if I have some fancy piece of art or really nice fixtures, like, do you consider that as an asset or liability in the third bucket?
All right, so the art and the fixtures, no.
Okay.
We usually discount that 100%.
Okay.
Right?
Okay.
Because typically in a liquidation scenario, I mean, I wouldn't know how to evaluate a piece of art. That's not my specialty necessarily. No, we can hire somebody to evaluate it, but banks don't want to get. The reason why liquidation of collateral is third on that list is because that's the last thing that a bank wants to do. Right? We have to go through a
That's
foreclosure
like if the
process.
worst happens.
Yes.
Okay.
And there's a lot of costs and there's a lot of time involved in that process.
Sure.
We have to hire a lawyer, foreclose on the property, then market it. And typically in a liquidation scenario, somebody wants to pay 50 cents on the dollar or something like that.
Okay.
Now, if there's equipment in the building, it depends on how that equipment was acquired.
Okay.
And the reason why I say that is because there are circumstances where we will provide a business with a loan in order to purchase the real estate that they occupy. And the equipment in that building, they finance that with somebody else.
Oh,
right? There could be manufacturer financing, for example.
Okay.
Or the equipment could be on a lease or something like that. So our lien does not necessarily extend to that equipment. That could be somebody else's collateral.
Okay.
And even if it isn't, right? Even if we have what's called a UCC lien on all assets of a business that we can file. Okay. Right? And in the event that that equipment does not already have a lien on it, then we could look to, liquidate that to get some money.
Assign some value to it. Okay.
Right.
Okay.
But in most circumstances, when it comes to liquidating the assets of a business, if there's real estate involved, that will get us the highest return.
I see. Okay.
Equipment and all this other stuff, people are looking to buy that at 30, 25. Everybody's looking to get a deal in a liquidation scenario.
I see.
And the bank wants to get rid of it as quickly as possible.
I see. So it's kind of like an REO in residential real estate.
Right.
Okay, so all of these moving parts, when I'm talking to my client who says, I want to buy something in the name of my business, how do they, and most often when I have that conversation, it's in the early stages of a business, I don't know, the first year or so when it's still a lot of bootstrap equity. How does someone set themselves up to be able to come talk to you and say, okay, my business is established, I want to buy a piece of real estate to run that business out of. What do they need to do to be ready for these three buckets of how they'll be evaluated?
Okay, so the first thing is typically
Yeah.
what a bank will do if they're providing you conventional financing. And I use the phrase conventional here to mean without a credit enhancement like the SBA.
Okay.
Right? So the bank is just going to be providing you with financing. They want you to be in business for 3 years.
Okay.
At a minimum.
Okay.
And they want those 3 years to reflect positive cash flow sufficient to cover the principal and interest payments of the loan that we're about to give you.
Now, do you establish that from like a Schedule C on a personal tax return, or are you looking for a corporation tax filing? How do you establish that?
Either one works.
Okay.
I do recognize that there are some businesses that are single member entities, if you will, and if that's the case, they can file taxes on their personal tax returns for the business, so there's a schedule on there.
Yeah.
We can use that.
Okay.
Or if the business files taxes separately.
Okay.
It's an S Corp, C Corp,
Okay.
LLC, whatever it is, but they file taxes separately. We'll use 3 years of tax returns from the business itself.
Okay.
Because we're collecting both anyway.
I see.
Because I remember we're evaluating option 1 for repayment and option 2.
Got it. Okay.
So your personal tax returns will take 3 years of that. Business tax returns and or other financial statements will take 3 years of that.
All right.
So the first thing to evaluate there is there sufficient cash flow here on a combined basis to cover the principal and interest payments needed? Second thing that we're going to take a look at, right, is the property that you intend to purchase. Where is it? Have you signed a contract to buy it yet?
Okay.
How much is the property worth?
Okay.
And I'm saying this fourth, but it really should be number one, is the equity that you're going to need to put in to purchase this property. Do you have it?
Okay.
And not only do you have it, do you have additional liquidity above and beyond that, such that once you put in, 25% down or 20% down to purchase this property, it doesn't completely eliminate all the liquidity that you have.
So almost like months of reserves.
It's very similar to the, right, so in your business, one of the things that they will say is, all right, fine, we want you to have reserves of X.
Yeah.
It is very similar in that sense. Now, it's not, it doesn't have to be a specific set calculation like that, where we're saying, all right, you need to have 18 months of debt service reserve or something along those lines. But we definitely don't want to make you a loan to buy a piece of real estate, and then when you put your equity into the purchase, all of your liquidity is exhausted.
Okay.
That's definitely not what we want. And you shouldn't want that either as a business owner.
Yeah, of course. Okay, so I just recently learned, I kind of have two questions and answer them in parallel, or if they're completely different, let me know, because I'm I'm a lot ignorant in this space. I just recently learned that you can make a commercial loan with agency financing, meaning you can sell it to Fannie, Freddie, I guess not the FHA.
Not the FHA.
But clearly, we can talk about that in another episode. But is that different than what we've been talking about? Like, are you evaluating? How does that work? I guess I'll start there.
So I am not as familiar with the agency element of it. So I don't want to speak to that in an uninformed way. I do know though that one of the things that commercial banks can do is they don't necessarily have to hold the asset being the loan, on their balance sheet.
Okay.
They can put them together and sell them off.
They can securitize them like we would a mortgage.
They can do that, yes.
I keep paralleling this to residential.
Residential.
If I am denigrating it, by all means, please stop me. Okay.
Now, most banks don't do that though, especially not community banks.
Okay.
And the reason for that is if the bank is trying to grow, the idea is we want to retain as much assets as possible on our balance sheet.
Okay.
Right? Because when you hear people talk about a bank is a $1.5 billion bank or a $2 billion bank or a $100 billion bank, what they're talking about is what are the total assets that this financial institution has on its balance sheet. And primarily, for a commercial lending institution, those are going to be loans.
The loans that you've made, evaluating the three factors you talked about early on. I see.
So if you sell those off,
Okay, then you're denigrating.
You are lowering your balance sheet at that point. So most banks aren't going to do that. But no, I'm not going to pretend to be familiar with any kind of agency financing relative to.
I just learned it.
To commercial banks.
So we'll figure that out. We'll learn together.
Okay.
So you said early on that what we've been discussing is more of a conventional way to do commercial financing.
Mm-hmm.
There are others like the SBA and other ways to do this. What is that?
So Capital Bank is an SBA shop. We now have our certification, if for want of a better word. We are now a certified SBA lender, which means that we can actually approve SBA loans without getting them pre-authorized or getting an authorization from the SBA first.
I see. Okay.
Right? So SBA programs are the programs that we use primarily as credit enhancements. So
that's the word I was looking for, credit enhancement. Okay, go ahead.
So in a situation where, for example, a business has not been in business for 3 years, or the business is a startup, or there is some kind of cash flow insufficiency, or maybe the cash flow isn't as steady as it needs to be historically, we can look to enhance the overall financial picture with an SBA loan.
Okay.
So there are a couple types of SBA loans that we use. The SBA 7A program, which is kind of like the flagship of the SBA, is a guarantee program.
Okay.
And what that means is that the SBA will provide a guarantee of your loan up to a specific dollar amount. It could be 75% or 80% of the total loan amount.
Okay.
I believe the 7A cap is $5 million.
Okay.
So with the SBA's authorization, or since Capital Bank is, a certified SBA lender now, we can do that without SBA authorization.
Okay.
We can provide you with a 7A loan for business acquisition, line of credit. Owner-occupied real estate acquisition as well can be done with an SBA 7A loan, and the SBA provides you with a guarantee.
Okay.
Now, you have to pay for that guarantee. It's not free. But what it does do is it incents the bank to provide you with a loan despite the fact that there are certain risks in the 3 criteria that we just talked about. Cash flow of the business, personal financial capacity of the owners, liquidation of collateral. There might be some shortfall in those 3 that the bank identifies, and they attempt to enhance the transaction with the SBA providing a guarantee.
So the SBA wouldn't necessarily replace number 2 in that scenario, the personal guarantor. It could plug any holes that you find.
It doesn't replace any of those 3.
Okay, but it can supplement. Okay.
Yes. It is in addition to that.
All right. So that's one credit enhancement program. Are there others?
So the other one, which real estate focused, is the SBA 504 program.
Okay.
And the SBA 504 program works a little differently in that it's not a guarantee program.
Okay.
So remember, I mentioned that the 7A, the SBA provides a guarantee, 75 to 80% of the loan amount. The way the 504 program works is there is a certified development company.
Okay.
Right? So the Business Finance Group, they're located in Fairfax, headquartered in Fairfax.
Okay.
And we partner with them. This certified development company actually issues bonds and uses the proceeds from those bonds to fund a portion of the real estate acquisition. So generally speaking, the parameters are vary based on property type and business type. Okay. But let's say you wanted to build a car wash. Yeah. Right? I'll use that as an example. You come to a bank and say, all right, I want $10 million to build this car wash. Once this car wash building is complete, I'm going to operate this car wash here. Okay. You can get an SBA 504 loan to do that. And the way that it works is the bank would fund 50% of that loan. Okay. The CDC, on behalf of the SBA, would fund up to 40% of the loan. They won't do that for a car wash because a car wash is a special use property. So, and if it's a startup car wash, they'll come down from 40% to
so
like
there
30%.
Are measures, risk-based.
There's some risk-based assessments that they make. But I'm just going to go with 50-40 changes for the purposes of this discussion. 50% of the bank funding, 40% from the CDC via bonds. 10% is the equity that you put in as the business owner. So what that does is, it's actually very interesting. It's similar to the 7A program in that what the bank is trying to do is reduce our risk in the transaction. If there's a 75 to 80% SBA guarantee, that means in a liquidation scenario, 75 to 80% of the loss the SBA is going to hold.
Ah.
In an SBA 504 situation, which is for real estate construction or acquisition, the bank only holds 50% of the risk in that scenario because the CDC is funding 40% of it.
Okay.
So it's really about a risk reduction mitigation
Okay.
calculation that the bank is doing.
Interesting.
Yeah.
This is a whole new world for me. I'm almost embarrassed to say I've been in mortgage real estate lending for 10 years, almost 11 now, and I didn't know this existed.
Well, to be honest with you, that's not necessarily that unusual.
Yeah.
There's stuff that you could tell me about residential mortgage financing that I would have no
That's
idea
fair.
of,
That's
because it's
fair.
not really what I'm focused on. So
That's why you make partnerships, build bridges. Huh?
I agree.
Okay, so when companies are either seeking these loans or trying to prepare themselves to be bankable in this way, what would you recommend that they do? No, let's not do that. What about the mistakes that they make? So when people come to you, what do you see as like repeatable mistakes that are being made when folks believe that they're ready for a bank loan or believe that they're ready for the credit, what was it called again?
Credit enhancement.
A credit enhancement loan, but you find out they're not really ready. What do you see as the most common mistakes?
So the most common mistake that I see in dealing with small businesses is this idea that the business entity is separate from you personally.
I see that a lot too, actually.
What needs to happen is that you as a business owner need to ensure that your personal credit is clean.
Okay.
Right? Your credit score. I mean, to qualify for an SBA loan of any kind, they have a minimum credit score requirement. I think it's 680, but I don't want to misspeak on that.
As an individual, there's a credit requirement.
Yes.
Okay.
Yes.
Okay.
Your credit score cannot be below a certain amount.
Okay.
If you've ever filed for bankruptcy, that counts against you. Is likely to lead to your loan request being declined.
Really?
If you've ever filed for bankruptcy. In some instances, it doesn't matter how long ago the bankruptcy was.
Really?
Yeah. Your personal financial capacity and the cleanliness, for want of a better word, of your personal credit needs to be of utmost importance. Because the financial institutions are using that as the basis for judging. And that shouldn't necessarily be the case. It is possible that you could have a 680 credit score and you are an excellent business owner on top of everything necessary to make this business successful. But it's just one of the things that people use, that financial institutions use to determine how bankable you are. Keep your personal credit clean.
Okay.
Right? Your personal balance sheet, you should also keep that clean, again, for want of a better word. And by that I mean, assets over liabilities. Don't take on too much debt. Don't leverage yourself up to a point where once you get a commercial loan, it's almost as if you can't manage it. Meaning that, because here's the thing with owning a business, and it doesn't matter how long you've been in business, right? Every business goes through ebbs and flows.
Sure.
Those ebbs and flows could be a function of things within your control as a business owner or things outside of your control. General economy, interest rates, etc.
Right.
In order to prepare yourself for these, since you know that they're going to happen at some point or another in time, what you need to ensure is that A, you have cash. Cash is king. Now, that doesn't mean that you're going to use your cash to do these things, but it's easier to borrow money. It's easier to borrow money when you have money. Right? Okay. So you want to ensure that your personal balance sheet is strong as well. Assets over liabilities. Don't take on a bunch of debt because it doesn't help you in the grand scheme of things. Right? Okay. Then you transition to the balance sheet of the business.
Okay.
And those two things are related as well because we often see that small business owners, they distribute 100% of the cash flow of the business to themselves personally. And then they end up spending it on acquiring assets that may not necessarily contribute positively.
Depreciating assets.
Yes, depreciating. I'm always hesitant to throw stuff like that out there because
part of that was me.
I know, but that's fine because part of the reason why I'm hesitant to do it is my mom was a business owner at one point. She bought this gas station and convenience store, which ended up going out of business for a whole bunch of different reasons that were some within her control, some without her control, right, or beyond her control. And I recognized that when you own a business, you put a lot of hard work, time, and effort into it, and you want to enjoy the fruits of your labor.
Yeah.
So one of the things that I always tell, prospective clients and people who want to get into small business ownership, or even if they're already in small business ownership, is delayed gratification is your friend.
Okay.
Hey, I get it. You want to enjoy the fruits of your labor. Labor for as long as you can before you delve into the enjoyment piece of it.
Yeah.
Because I like fancy cars just like everybody else. I mean, I don't wear jewelry, but I don't. If you want to wear jewelry, that's fine, etc., etc.
Be sure you can support.
Be sure you can support those things. It's almost like if you are going to spend money on depreciating assets like that, it needs to be money that you could throw away. Mm-hmm. Right?
Yeah.
They have these ads on TV. I watch sports a lot, so they have these ads on TV now where they're trying to promote gambling, right? Because it's legal in so many different places. Exactly. And then one of the things they say is only bet an amount that you're willing to lose.
Yeah, that's right. Okay.
Do the same thing when it comes to acquiring depreciating assets. Yeah. Spend only the money on that you would throw away in Vegas.
Right. And don't go to Vegas with rent money. Is the way I heard it. Like go with just enough that you can lose and not. Right. Exactly. So this is just really scratching the surface of all of these things. And we will probably have to, if you're open to it, have you back to deep dive in any one of these. And maybe, ask some questions. You guys out there, give me some questions in the comments. What do we want to have Chris talk about when we bring him back? I am happy to, I think that one of the differences between being a commercial lender and other types of financing, especially a commercial lender at a community bank, is that you oftentimes end up being a financial advisor of sorts. Because the small business owners tend to have an area of expertise. Yeah. And then once you get outside of that area, I mean, you could say that about all of us, right? We were just talking about, the aspects of commercial lending that you're not familiar with. And I was just saying that, the residential mortgage thing is something that there's any number of things that I don't know about it. I think the same thing happens with small business owners in that they are focused on one particular thing and they have a specific area of expertise. And then there's all these other things. The things that are like orbiting around.
Right, that they don't have an expertise in. And some of them expect it, meaning expect you as a commercial lender at a community bank to be able to advise them, if you will, on what's a good option and what's not. And that's something that I try to do, even in a circumstance where the business owner that I'm talking to is not going to be a client of Capital Bank. I tell people all the time, even if we're not going to do business, if there's any information I can provide you with, or if there's any connection that I can make for you, I'm happy to do that.
That'll come back in bucket.
Yeah.
Okay, so party question to all of the guests. The name of this podcast is Coffee and Kale because they're the two things that keep me going. Coffee in the morning and some version of this kale drink you have had here today at some point. Good. During the day. So, what about you? What are the 1-2 handful of things that keep you going? That's a
good question. And you mentioned it to me prior to me coming on here, and I had to stop and really think about it.
Okay.
And what I've come up with is peace and legacy. So I think the thing that drives me as I go through each workday, as I go through each day, whether I'm at work or not, is I want my peace of mind and peace of spirit to be undaunted and unbothered. I want to get to a point in life where nothing can disturb the tranquility that I have mentally and psychologically. I haven't gotten there yet.
Okay.
Right? But one day...
We're all seeking something.
Yeah, one day I hope to do that. And then legacy. Okay. I've thought about that a little bit, and something that popped into my head is, oftentimes, whether it be on social media or in the news or whatever, you'll hear about somebody who is like the fitness guru to the stars, right? What I would like my legacy to be on a much smaller scale is the person that any number of small business owners think of when they're like, all right, here's someone who assisted me in getting to a specific goal. Here's someone who helped me grow my business. Someone who connected me with someone else that helped me grow my business. Someone who gave me advice And not advice that was necessarily transactional, meaning I was giving it to them because I wanted something in return, but who cared enough about the final outcome of my efforts as a business owner to spend the time. That's the legacy that I hope to achieve, but we'll see how that works out. So those are the two things that drive me every day.
Well, thank you. Thank you for sharing that, and thank you for joining.
Oh, you're very welcome. The time went by so quickly.
I know. It really did go fast. Thank you again for joining us. Thank you guys for being here today, and come back for the next episode of Coffee and Care.